Welcome to webinar 2 of 7, right? Last week, what we did was cover, building a trading foundation, where we went into the depths of just price action and how you could, kind of set things up from a very basic level. And we really did, I think, was one of my best ones in terms of communicating my knowledge, bar by bar type of breakdown on how you could see the markets and from a price action perspective, how we can get better as a team. So today's webinar is about once again, this is 100% free. I would appreciate if you guys can share this, repost it, give it to anyone that could be starting in the markets or is experienced. I think this will serve as a guide over the next many years for many people and be very helpful. And that's the reason we're doing this. And that's the reason it's 100% free. So your enthusiasm helps us work even harder. And the more you guys share this, the more people we get in here, the more we could impact, some of the traders that are, again, like we just spoke about, stage 1, 2, and hopefully by the end of the 7 webinars, we don't promise that we'll get you to stage 3, but maybe 2.5 or 2.2, right? Like some of you said in the last one. So framework 2. Framework 2 will focus on edges, mindset, and setups. We will cover some of the very basics of how successful traders have, built some of these frameworks and how they kind of, time the markets, whichever way they've chosen, be it stage analysis, be it canceling, be it VWAPs, be it 5-minute charts, be it higher lows, or RSI, MACD, etc. Right? We will dive deep into what each of these 3 things mean, and I call them the 3 pillars of success. And they kind of build any trading methodology out there is built on these. Any successful individual, firm, person have they've kind of taken components of this, be it purely technical, be it purely fundamental. It all comes down to these 3 pillars at the end of the day. So we're going to dive deep into each of them, and then we'll present some of the, some of the technical setups that we look at, and some things that you guys can look at to master, or you could apply this to pretty much any strategy in trading or investing. This is not kind of specific to a certain setup, or specific to a certain type of market. It's it's the concept of how you can solidify these 3 pillars so that whatever strategy you choose in the future or are employing at the moment, it's going to help you either way. So before we get started, right, we had the pledge. The pledge is basically to say that you guys will work as hard as we are. You'll put in the work. You'll ask the appropriate questions to learn and improve. And the time equity that we're putting into this, we want to see that feedback. We want to see a lot of questions. We want to see a lot of, enthusiasm from your guys' end, so that we can, fuel ourselves, off of that. And it will be a 2-way street where your energy will match your energy, and we will do everything that we can over the next 7 weeks. This is week 2, to make strides, make things, easier for you to move from stage 1 to 2 and 2 to 3. Over the next 7 weeks. The agenda today is, we will kind of start with our ultimate goal in trading, investing. What's the purpose of waking up at 9:30 Eastern, tracking the US markets? What's the purpose of waking up at 9 a.m. in India, right, to see that market open? What's the purpose? What's our goal, right? Why are we doing this? And what are we trying to get out of it? So we'll go into the depths of that, because I think having a clear goal is, having a clear, plan, goal, whatever you want to call it, is very important to have that mind clarity so that you could kind of go towards that. We'll start there, then we'll get into the 3 pillars that can shorten your curve, which would be mindset. We're going to get into the depths of mindset. What is an edge? What is a setup? What is a pivot? And some examples of 3 setup, very simple setups that I use, Richard uses, and how you can just take those, incorporate them, and you will see a significant difference in your results. So I would like to start off with what is our ultimate goal, right? Why are we doing this, and what's the purpose? And that's something maybe you guys can put into the chat on what you feel is what's the primary goal of what we're doing and why we're doing it. So let's see some of the responses in the chat. You don't have to agree with what I have up here, but it would be nice to see why are we doing this, right? Money and freedom of time. Make money, right? Financial freedom. Trade better, make money, purpose over emotions, extracting income, escaping the boss. That's a good one. Right. So the consistent mindset that I see in the chat is we need to have some sort of, our goal is to at the end of the day to make money. And that is not our goal. And it all starts with our mindset. What is our goal? Our goal is, sure, you could put, you could say that I want to make money and that's the only thing that I want to do. And that could be one way of approaching things in one mindset. And what we saw in, a trader that goes from stage 1 to stage 2 to stage 3, the common theme in stage 1 and 2 is they keep losing money, right? So if you're a stage 1 and 2, which we saw in the last webinar, many of you are stage 1 and 2. Some are a bit ahead of stage 2. The mindset cannot be, I need to make money. That puts you in a state where you're letting your emotions get the best of you, and the market is exploits emotion at the end of the day. So if you put yourself in that mindset that I have to get a result in the shortest span of time, and you forget everything else, it puts you in that state where you're making rash decisions. You're making bad decisions because you're acting desperate. And something that Nick Schmidt always says is the more desperate that you are, to extract an income from the markets, the less likely you are to succeed. He probably says it 10 times better than I did, but that gets a point across. So our goal as traders, investors, is we want to move from stage 1 to stage 2, and we want to, upgrade ourselves from stage 2 to stage 3. If we look at the depths of what we see in stage 1, we see that we're consistently losing money in the markets, right? That's the gist of it. We're trying to turn that ship around to get to stage 3. In stage 2, we figured it out a little bit, but on a net basis, we're still losing money in the markets. So if our mindset switches from, this is a journey, this is going to take some time, I'm going to staircase up the steps to get to stage 3 and not try to, jump a whole bunch of, steps and try to get to stage 3. Because stage 3 is all about what you learn in stage 1 and 2, you combine and put that together and you take that to stage 3. That's how you get to stage 3. So the mindset that if a stage 1 trader has a mindset, I need to make money and that's the only thing, I need to figure it out, that's how they consistently keep losing and losing and losing some more. The same thing in stage 2. It's the same exact kind of mindset. You know that you have something on your hands that works, but you can't really keep it because the mindset hasn't, switched. If you watch Mark Minervini, you follow him. If you watch any of these traders on basically Twitter that have, a good track record of following, they're always focused on the other side of this equation. They're always focused on risk management. How do I minimize my risk? How do I make progress, while sizing up? How do I stop losing money so that I can then start making money in the markets, right? Making money is not a goal that meant, it could be our bigger, the bigger umbrella, right? But it's a byproduct of our habits. It's a byproduct of our routines. It's a byproduct of our mindset. And all those things, when combined together, result in that, the bigger goal of a stage 3 trader. So our mindset has to shift from the fact that we're not, yes, we're in this to make an income, extract all of that stuff. That's perfectly fine. But as stage 1 and 2 traders, your mindset has to be, I need to stop this equity curve from going down. I need to stop this from happening. And once you stop this from happening, mathematically, there's no other way but to get to stage 3 if you have that mindset. So,
and can I stop you there for a second, Ryan?
Yeah.
Bringing it back to today's topic, how do entry setups and edges play into this mindset shift? How can we switch from being focused on just making money to, stop losing money? How do setups play a part in that?
So the commonalities of stage 1 and 2 here is you don't have an edge in the markets here, right? Stage 1, you don't have an edge. You don't know what you're doing. You're just making decisions based on some level of emotion day to day, and you're consistently losing money in the markets, right? Stage 2, you figure some of it out, but you keep giving it back, but because you lack consistency and emotion takes over, you get euphoric at these highs and peaks, right? And you lose it all, and then you're back into that kind of boom and bust, right? That's exactly what this is. Your emotions are booming right up here, and then when you lose it all, you're just saying, I don't think I've figured it out yet, right? So these two, stage 1 and stage 2, the only difference in stage 1 and stage 2 is you have something on your hands based on the experience from stage 1, but you're not able to handle it. Now, these 3 pillars that we're going to discuss are going to focus on, one, giving you a definitive edge so that you can't be random in the markets and you can't be emotional or less emotional in the markets. And where we, when we talk about these 3 pillars, they will help you kind of minimize that loss. But the primary, reason is you're going to see consistency in your behavior. You're going to see consistency in your decision making. You're going to see some sort of consistency in your emotions and how you handle them. And when you have consistency in all of those things, that's how you could transition from 2 to 3 or 1 to 2 at the end of the day. I don't know if I answered your question, Richard, but
yeah, kind of what I was getting at is the best traders, the setups that they've chosen to specialize in, their number one thought is, how do I get out of this if the setup fails? How do they protect themselves from a large loss? I see in the chat, how do I protect myself from a gap down? It's all about managing risk through these setups as well as your position sizing, right? So the setups that we're going to cover today, it's very clear when they fail. The Launchpad, which we'll cover in depth later on, if the stock falls through the moving averages and starts getting to the downtrend, that's a violation of the setup. So I guess what I was getting at is mastering setups and specializing in one setup allows you to build intuition into when it's working, when it's not working, and that allows you to help stop losing money because you'll know quickly if you're wrong and you'll exit. So that's kind of the point I was getting at to add to what you're talking about. But we'll expand on that later.
Yep. So let's keep going. So the 3 pillars of success, right? So edges, mindset, setups. These 3 things are, a common theme that we see for successful traders and investors in the market, right? You could have a technical edge, you could have a fundamental edge. I know traders that trade based on news only, and that's also an edge. But what they're doing is they're doing that same thing over and over again for them to have an edge over the market, right? They're not moving from a MACD setup to an RSI setup to a some cloud setup, then try Fibonacci's, then do this and do that. And week to week, they're not, or month to month, they're not switching from one to the other. Yes, initially as stage 1, as we all go through it, we do that. I think that's a good thing. I think failure is a good thing when you go through those, iterations of what you think will work for yourself. But at the end of the day, when they're at stage 3, they have a very specific list of what they're looking for, and they consistently stick to that domain, be it fundamental, technical, or techno fundamental, whatever you want to mix it up, right? But that's one of the consistent, pillars of success that we see among successful traders. You can take William O'Neill. He built, he said, what are the biggest winners in the market? He worked his way back, right? And said, hey, looks like stocks that technically form cup and handle seem to do this and that. Stocks that move up the 37% of the industry, of the movement of a stock is related to its industry. How did he do all of that? He built, he worked his way backwards to build an edge and a system or a framework. Stan Weinstein, if you hear his interviews or you've taken that master class, said the same thing. He said, I learned through my failures. I used to see these stocks and I couldn't time them whatsoever. And I would see that, over repetitive failure over many years, I would see that stocks have the stage 1, 2, 3, and 4. All of this stems from a level of failure that they experienced at stage 1 and 2 to move to stage 3. But they were really specific in this, defining what an edge is, defining what framework they will be using, defining how they're going to operate in the markets, defining sort of a business plan for how they will go about this, right? So that's the first pillar of kind of, the success that we see or the commonalities that we see, be it any successful trader that you pick in the markets that has, remotely made, some money or a large sum of money. The second we will get into is the mindset. The mindset that they function upon is based on risk management, is based on how do I minimize, whatever it is I'm doing in terms of risk. How do I, make sure that when I lose money, it's as little as possible, but when I do make money, I put the odds in my favor, right? And their mindset, they're not looking at, hey, I have this setup, if this depth is this, and then I'm gonna draw a line all the way up to 120% above, and that's my profit level line, right? Very few people seem to function that way. They're all focused on risk management. How do I lose the least? How do I control what I'm doing so I can minimize my emotion? And money will be a byproduct if I do anything but think about if VRT moves up from 80, or 30 to 60, I'll be up so much. They don't think like that whatsoever. And the third is they all have setups. So setups you could define as, Stan Weinstein has his setups. He calls them the 4B minus, the stage 2. At the end of the day, these are characteristics that he sees and he repeats over and over again, and he looks for to enter these names from a technical perspective. William O'Neill did the same thing. He would see these names, he would see the basis form, he would see the fundamentals, like ROE has to be above 17% on all the biggest leaders I've studied in the markets. He would have very specific setups that he would operate upon to yield a return, right? So let's go back to a mindset a little bit and kind of deep dive into that. So the mindset of a stage 1 trader is that they need to make money and there's no consistency in their routines, habits, the way they operate. They don't have an edge. They don't have a setup that they operate upon. It's absolutely random. You wake up and you try new things every day. You learn. I think it's good to go through stage 1. You learn from your failures. And then you figure it out and you say, hey, I can't be doing everything. I need to operate within my, wheelhouse, my, my circle of what I understand how the market, is operating or how the market works. Then they move to stage 2. Then the mindset kind of switches from, I have something on my hands, but I'm not able to keep it, right? I'm not able to keep the gains. I do have these spikes that I see and I make a large sum of money all at once, but I seem to lose it. And then we migrate from, a lot of years of frustration. Then we migrate, well, we figured something out where we make a whole bunch of money and we learn to keep it. We make a whole bunch of money, we learn to keep it, right? And we see these strides. Obviously, there will be times where you catch a big gap down and this thing moves all the way back here. That's perfectly fine. Or you catch a big gap up and this pullback doesn't happen and you spike up and you continue going higher. But you figured that if I operate on these 3 pillars of my mindset being, I need to focus on minimizing my risk. I don't need to focus on, hey, I just need to make money every single day in the markets. That type of mindset doesn't work. They have very specific frameworks or edges or setups in the market that they operate upon, and they only internalize and build that self-confidence to go from stage 2 to stage 3. And that's really the difference, those 3 pillars. The next thing in mindset is there's some consistency in thought, right? There's some, as you reduce your randomness in your actions when it comes to the market, you will be more consistent in what you're doing. You can always tweak a little bit to see what happens at stage 1 and stage 2. But when you migrate or upgrade to stage 3, you have this consistency in routines. Someone like a Mike Webster, he has, Sunday morning, I'll open up charts, I'll run these scans, I'll continuously scan the markets. There's a consistency in what he's doing to build an opinion, right? Mark Minervini does the exact same thing, Saturday morning, Sunday morning, they wake up, they look at the markets objectively, and there's consistency in thought. They don't all of a sudden look at Nvidia's CEO is selling a whole bunch of shares, and now that's my new edge in the markets, and I haven't studied any of how inside ownership works, and it's trending on Twitter, and there must be some conspiracy that's going on. Let's throw everything I have, in terms of my 3 pillars of success, and all of a sudden they're random in their actions. They don't do that. None of them do that. So there's a consistency in thought process that they exhibit, and that comes through, a whole bunch of failures from stage 1 to stage 2. All those learnings are packaged up for them to be stage 3. The second is inputs and outputs. So inputs and outputs. So as you build and you learn, the only way you can find some sort of consistency in what you're doing is what you're consuming and what you're applying, right? So if I take, let's say, I can be a trader and I can purely trade Fibonacci's. And I guarantee you, if I throw everything else out the door and I trade Fibonacci's for 6 to 8 months, I will find some consistency as to what pattern, what is going on in the markets. All these indicators that we see, right? All these indicators that we see that are named after people, these were wildly successful people that saw a consistency in their inputs and built indicators to see consistency in their outputs. So they operate, that's why I say, and I'll get into this a little bit later, all indicators work. It's a matter of consistent input to see consistent output. Then you tweak your inputs, you get a better output or a worse, and you do that repetitively, right? And repetition, and you can master that particular aspect, whatever it is. If I look at balance sheets, right, and I look at income statements for a span of 8 to 12 months, I guarantee you I'll see, I'll have a whole different mindset of what I feel true market leaders will be doing based on forecasts, analyst estimates, etc. But it has to be these 2 things, the consistency in your inputs and outputs, so that you could see what is working for you and what isn't working for you, right? I'm an engineer by trade, so my background is in electrical engineering. I tend to be more mathematical in my approach. I tend to be more definitive in my approach. I want to see it on paper. Whereas some of you might have a science background or some other background or accounting background or a financial background, right? We will all think in certain ways, but these things don't change. If you're not consistent in your inputs and outputs, and you're not repeating what you're trying to do, you will never see that stage 3 at the end of the day. The fourth is incremental improvement. So this is a process. You will not skip steps. You cannot skip steps. If you're going to be wildly successful, if you're going to be very successful, you have to think that I will improve week to week. I will get better week to week, month to month. And it's not about how do I skip everything? How do I sign up for a service that just negates all of this, and I just instantly and magically can be the best I could be as long as I can just follow someone into a name and get out, etc. That mindset may work in a really, really good market, a really good market where it's you almost like you have a magic wand and someone says this thing's moving up. It's the 2020 market. It's not going to happen for a very, very long time. Those are euphoric times where anything you touch, people are buying, pictures of monkeys and making millions, right? Those times it might work. But if you look at your journey over a bigger span of time, right? If you look at, you have to take steps to internalize what you're learning, to do this yourself and make this a journey about yourself at the end of the day. So this one is longevity over excitement. So a lot of people look for excitement in the markets. They want to buy 2,000 shares of something, have it rip up, and they're super excited. They're over the moon, right? And They want to do that over and over again. It happens, it tends to work, but again, traders that are in this for 2 decades, they hate volatility. They have developed, almost like a block, from a mindset perspective, where if there's volatility, I want to run the other way, because they want to survive, and they know that if they could survive and not catch a landmine, they will be far better off than chasing excitement in the markets, right? This one is self-confidence through market studies. So self-confidence is all about internalizing whatever it is. If you want to go out and trade VWAPs, if you want to go out and trade Fibonacci's, you can go out, grab that knowledge, but you have to internalize any aspect of what you're doing, of your own decision making, and you have to build that self-confidence for you to operate when the market is live and you are ready to make decisions. It all comes down to you and the market. At the end of the day, the market's going to exploit your emotions. You have built systems that kind of minimize those emotions, so that you can continuously kind of make rational decisions. But at the end of the day, that's all we're doing, right? And we're doing that again and again, and then seeing differences in our equity curves. This one is about habits and routines. So habits and routines are not, this is not rocket science. These are not, concepts that are solely tied to trading. Habits and routines matter in any professional, sport, any professional, anything. You need to have some sort of habits and routines to keep you, to have balance. I think balance is always forgotten for stage 1 traders, especially. They make the stock market everything, and they're on their desk. They feel like 10 to 12 hours of this, and I'll have some breakthrough indicator that will bypass, we've all been through that, right? Every one of us has been through that. So habits and routines are kind of tapping into, how can I be consistent? How can I have repetition in what I'm doing? And habits and routines kind of play off of that. I think balance is very important. I think at the end of the day, when we're making decisions, if you haven't slept, if you've slept for 4 hours, you wake up at 9:30 and you expect your mind to make a good decision based on what you've done, you're really asking your body to do a little bit too much. So as a professional, as stage 3s, those things matter a lot more. Are you away from the desk enough? Is your mind fresh? When you look at the markets, you've done your prep, you need to go away. You come back at 9:30 or pre-market, whatever the case might be, and you look at things from a fresh, we need our brains to kind of function. And this is a key and, important aspect for many of stage 2s to go to stage 3s, etc. And the last one, it's not just about trading and investing, right? You have to balance. You have to have other joys in life. You have to have other hobbies in life. You have to kind of make this a 50-50. You can't just be here and say, if you read William O'Neill's book in one day, I guarantee you it won't make you profitable, because your mind's not there. You're saturating your efforts in order to be desperate to make something happen in the markets, and desperation doesn't work. And that's with any kind of profession as well. And the last one is managing it like a business. So being a professional is, again, this is not some, trait that is required in trading only. This goes for anything, right? If you own a business and you run a shop, or you need some way of operating that is sane, and you treat it seriously, and you're ready to see results. And that mindset, this is not, I will maybe scan for stocks once a week, and my expectation is I should be up 250%. Or my expectation is I will subscribe to the service. That means I don't need to do anything else. All I need to do is wait for this alert to come through. I'll go buy, and my life is going to be great. None of that crap works. At the end of the day, you have to manage your own business. You have to have your own, setups, entries, risk management systems, emotional management systems, etc. And you really have to have a solid business plan. Hey, I am going to do this. Yes, I will go out and get knowledge from somewhere, but I need to internalize that. For my success is dependent on me, not someone else. At the end of the day, that's how these traits that we're highlighting, these are traits that successful traders seem to exhibit, right? Maybe they don't exhibit all of these, but for the most part, you know, that this is what they're doing at the end of the day to stop losing money. That's stage 1 to stage 2. And then to go from stage 2 to stage 3, it's more about emotions and improving and tweaking some stuff to get from 2 to stage 3. So Richard, I'll pause there because I've been talking for I don't know how long, but questions, you know, things of that nature that we could discuss.
Yeah, at this point in the chat, everybody leave kind of their thoughts on mindset. I saw some come through, or any questions that you'd like us to cover in this section. We'll kind of pause here and then we'll dive into the edges and setups. So let us know if you have any questions on this. And I think, Rye, as you were talking about this, I was thinking about, you know, how much Stan talked about, you know, especially the kind of middle longevity over excitement, habits and routines, not just about trading, investing. He really stressed to us how important it was to step away, you know, go for a walk on the beach, you know, watch some TV, whatever helps you kind of reset your mind and prepare your body and thoughts, you know, for the next trading day. Super, super important, especially if you want to be doing this for 30 years, 40 years, 50 years. If you're, you know, always at 1000 and you're ready to go, you're all about excitement, and you're going to burn out, right? You want to have setups and routines and processes that keep you in the game for the long term, because that's where the compounding really takes hold, right?
Yeah, and I see some questions, you know, how long is it going to take me, right? How long is it going to where the you know, a light bulb goes off? And it's different. And I'll give you guys a few examples. So Oliver Kell has been trading before his championship run was 2.5 years, if I'm not mistaken. But less than 5 years, let's say. He was very new, but he figured it out quickly and he saw success in the markets relatively quickly. Me, on the other hand, it took me 7, 8, 9 years to just, you know, go through this, lose a whole bunch of money, lose it again, lose it again, lose it again, and then figure it out from there, right? And a lot of this slide contains a lot of pain that I experienced that I wish I could have done a lot sooner to get that 7, 8, 9 years, right, of work closer to maybe 5, 6, right? It's very rare. And it kind of pisses me off when I see this, but like, hey, sign up for this, and in 2 weeks I'll teach you all the steps you need to know, and you're good to go forever. It just doesn't happen at the end of the day, right? So it takes a little bit of time. If you develop a feel, you develop you know, a gut feel for what the market's going to do as you track it over time, a span of time. You can start to you go from interpreting, right, which a lot of people are big on. I only interpret what the market is doing, and then I place, you know, do this and that with it. As you gain more experience, you go from interpreting to anticipating, right? Interpreting is you looking at your existing state and you're saying, hey, this is happening, and, you know, this is my current, you know, what view on the market. So you go from that to saying, hey, I've seen this before. I think, you know, I'm gonna maybe place some of my bets on, you know, this area of the market being oversold, and it's going to bounce. I've seen this so many times over the span of 15, 20 years that I've been doing this. So that comes with time, right? That comes with market cycles. That comes with studying a whole bunch of market cycles so that you can relate different things to different span, you know, in time. And all of that, at the end of the day, when you place a trade, you get into the state where you have a good feeling about it, and you feel it that, you know, this is pretty good, and you get a bad feeling pretty much right away as well. So like you said, Richard, like intuition is a byproduct of time, right? And these things take time. These won't be, you know, in stage one, 2 years in stage 1 year in stage 2, and 1 year in year 4, you're so good that if we had that, we would have, you know, everybody at home just trading it at the end of the day, and not doing any other, you know, jobs for if that was the case. So it's a bit of a journey. If you survive stage 1, you go to stage 2, the chances are much higher, and you take it seriously, right? You manage it like a business. You move from stage 2 to stage 3 relatively quickly. At the end of the day, it comes down to looking at the reality of what is happening, right? Looking at what you're doing, looking at your inputs and outputs, repeating what you're doing, and try to improve that over a span of, you know, many iterations. That's what kind of it boils down to. Many traders tend to mask themselves. If they're not getting results, they still look the other way and say, hey, I'll eventually get results if I just keep trying this and that, rather than looking at, hey, I'm doing this and it's not working for me and I'm not making any money. I need to, fix my issue that I see in my equity curve or my setups that I employ, and these are not working for me. Like, what is going on, right? So it's a little bit of, as humans, we tend to not expose our own failures rather than we shy away and hope that they go away one day. Whereas the better, traders that seem to learn quickly look at exactly what they're doing, saying, what the heck am I doing? It's not working. How do I, tend to improve this right away? They look at they magnify their failures a lot more to get to stage 3. So I don't know if that answered it, but
Yeah, I think it takes at least a few market cycles, right? And we just did the class with John Boyk, and many of those legendary traders, it took around 6 years, right? So it takes time, but the harder you study, you study history, you study setups, you study historical winners, you can, accelerate yourself on that path. I think we can push on here, Rai. Let's go ahead and get going. So equity curve mindset, yeah, this is really important. So definitely.
Yeah, so we talked about, making money is not a goal that we could have in stage 1 and 2. I think goals for stage 1 and 2 are having proper processes, routines, habits, consistency, and input, output, and treating this like a business. You will learn a lot of that in stage 1 and 2 as you go through them. But at the end of the day, if you look at your equity curve, which is what stage 1, 2, and 3 are made of, right? The evolution of a profitable trader, that diagram. Stage 3 is seeing higher lows in equity curve, and stage 1 is seeing lower lows in equity curve. So one way to kind of, like I said, look at your results, look at what you're doing, look at what you're doing and why you're doing it, boils down to looking at your equity curve and seeing what happened over here. How can I replicate this as much as possible? How can I replicate this as much as possible? And you'll tie in those common threads. When you look at your equity curves, you'll tie in those common threads and say, hey, looks like when I wait for this XYZ in the markets and I wait and I'm patient and I look for these things, I tend to be doing well. And when I'm not, operating upon these frameworks, I'm not doing well. And that's the raw truth, right? You're magnifying why you're giving back money to give a little bit less away, and you're magnifying your own successes to see, even if you're a boom bust, you see these spikes and you give it away. You see these spikes and you give it away. You're looking at these spikes, and magnifying those to see, hey, what is going on in this time span or this week? What is going on in this, pullback that I'm experiencing? And at the end of the day, if you have, this is likely 8 or 12 months. You go sideways and you make a whole bunch of money. You go sideways and you make a whole bunch of money. You go sideways and a whole bunch of money, right? And there are these famous quotes by many traders and investors. You seem to, when the market's cooperative, it's much easier. When the market's not cooperative, unless you're some, absolute wizard, you could just trade both sides and you're doing this and there's no way that you could give anything back. Very rare, again, unicorn type of thing. Doesn't seem to happen. So look at your, I would say if you're here today and you're looking at, your numbers, if you're not looking at your numbers, you're doing yourself injustice. It's probably why you're still in stage 2. I would say look at why these things are happening, when they're happening, and look at why you're giving back, back money and why that's happening. If you just quantify or try to look at those periods and see, these feel-good moments that we have, and then there's nothing to do in the markets, then you have a feel-good moment. What is happening in those moments, right? Try to quantify that, try to magnify it, try to look at it so that you could get this higher low at the end of the day, right? So you're making consistent progress. You see you're being rewarded for your efforts that you're putting in. And that in and of itself is a big, mindset. It builds positive mindset. It allows you to stay within your wheelhouse. It allows you to, execute upon the 3 pillars that you put for yourself at the end of the day. So I think this is important. I think a lot of stage 1 traders, if they just look at their equity curve and say, hey, what the hell am I doing? Why am I doing this? Why is it trending downward? they would automatically come to this conclusion that I need to restrain myself. I need to be a little bit less emotional. I need to put in things to stop myself from myself. And that's how you kind of turn that ship around at the end of the day. So, Richard, anything on that you want to add?
No, not really. I think you covered it well.
Perfect. So the next thing, I want to keep it to mindset. I know a lot of you are excited to see setups and edges. We'll get to that. Well, I think it's more important. This is a lot more important to turn around a lot of stage 1 and 2s to 3s than putting up a setup and talking about charts. So ruthless mastery. So there are 4 steps, to try to master something, right? Deliberate visualization and building awareness of the current situation. So if you go in and you have a framework and you say that, hey, I've looked at the markets and I've visualized, that's how we look at charts, and I've built some awareness of this current situation that the market may be in or my portfolio may be in, just having awareness of what you're doing and what you trying to plan your actions in a way will have a huge impact on your results at the end of the day, right? Just be aware of what the market's doing. Be aware of what your expectations might be of the market. I think having some sort of expectation is fine, right? I expect when the S&P is below the 50-day, I expect that my portfolio will likely not be rocketing higher or something like that. I expect when the market is downtrending and when I'm short, for example, I expect my equity curve to rise because I'm doing something right or in line with this market cycle, be it uptrend or downtrend. So try to deliberately look at what you're doing, try to plan your actions as much as possible, and you will get from a stage where you're interpreting and you have a set of, a plan, things don't go according to plan, and then you get better and better. So you take that loop and you will get better and better as more market cycles happen. Building subconscious feeling and instinct. So this comes with time. If you were to put time on x-axis and you say, what's the level of how do traders operate on feeling? Stage 3 traders will operate the highest on feelings and instincts, and then stage 1 traders, because they don't have that yet. They're building that, right? Stage 2 traders are building that subconscious, and that comes from studying the markets. That comes from looking at that comes from experiencing week to week what the markets are doing. The third is converting emotions into an edge. So we did this masterclass with Jared Tendler on just trading psychology, and he introduced these frameworks that some traders say it's all a load of crap. Some traders say, hey, this helped me so much and accelerated my curve, right? At the end of the day, it comes down to the individual. I think it tends to help to see and see how you're feeling, what you're doing, and put some frameworks around that as much as possible, right? And try to convert. As we're emotional beings, when we look at price rise, we feel good, right? If you buy some stock at 50 and it goes to 55, you're just like, hey, I might be a genius, I'm feeling pretty good. I don't really need this and that. Hey, I'm gonna quit my 9 to 5, and I think it's I'm ready to go. And then when that 55 comes back to 45 and you're down $5 per share, you feel the complete opposite. Maybe this is not for me. I don't know what I'm doing. I'll go try something else. And your emotions, the market's just exploiting your emotions day to day at the end of the day. So having some framework, having some emotional, ways to minimize it, you will never get rid of it. Traders, Ross has been trading 30, 35 years in the market, right? Since he was actually 18. So that's something he always said, emotions never go away, but we need to find some way to kind of basket or some kind of restrain ourselves from ourselves. And I think this is, part of ruthless mastery. You have to find ways to have, minimize your emotions. The last one, which I think is most important, is you have to study what you're doing. And this comes to, if you were a physics professor in some university and you haven't studied what you're kind of teaching, or you want to master the field of physics, you want to master the field of whatever it is at the end of the day, you have to look and study historically what's happened and what are some of the inputs into the market. Well, humans are an input to the market. Money managers are an input to the market. Institutionals, hedge fund managers are an input. How are they functioning? What are they doing? How does that show up in price action and volume? How is there some consistency in behavior, right? Whereas people tend to interpret Mark Douglas's quote a little bit different than Livermore's quote, as every moment in the market is different and there's no point, that some traders take that as, I don't need to study history, every day is a new day, let's go out, have some fun. Those people are not successful. There's some rhythm and rhyme to this at the end of the day, right? There's some consistency in behavior of how things are happening. That's how William O'Neill wrote a 400-page book. That's how Stan Weinstein wrote a 300-page book. There was some consistency in connecting some prior state. Hey, I've seen Amgen in 1990 break out based on this, and that from a technical perspective. And I see that in this stock, ISRG in 2004. That they're connecting some state to history, right? They're learning what they had, traded back then, what they learned from it. They leverage that experience, bring it to the current market, and try to exploit the market and make it a bigger source of income. So these 4 things are very key to some sort of mastery of the markets. I think you'll never master the market, but you need some of these things to develop over a span of time to, again, move away from stage 1 and move away from stage 2 as much as possible. The last one, and I promise this is the last one on mindset, is studying the markets. I think at the end of the day, so now let's zoom in a little bit, right? We've talked about, physics professors and all of that stuff, and how, these things are not common. These things are not just restricted to trading. Let's talk about the markets a little bit, because that's what we're trying to accomplish, right, as a team. So zoom out and look at the bigger picture. So study different market cycles. Study what happened when there was a credit crisis. Study what happened when the Fed does X, Y, and Z. I think those things are good. Those things, you should go out and kind of consume that. It's fine as long as you internalize and say, hey, does this fit my system? Does it help me as to what I'm doing? Some traders say, absolutely, right? I see that when the Fed is not cooperative and not just dishing out money, it seems to be a little bit harder to make money in the markets. And some people just operate based upon that. And they're successful. They're investors, that just look at, let's say, dividends, and they just make a dividend portfolio, and that's a goal. Whatever it is, zoom out, look at the bigger picture, look at different market cycles, see if you can find some consistency of how you view it. A lot of it comes from background. If you have a science background, if you have accounting background, if you have an electrical, engineering background like Richard and I have, you will think about the markets a little bit differently. Try to exploit some of that and leverage your background at the end of the day, right? The second is try to find common threads. So for me, when we'll discuss the edges and examples, I find I trade the best when I see a market is in an uptrend. I see multiple stocks exhibiting the high volume edge, or PEG, or EP, or any name you want to give it, right? And I see that common thread back in history with a Google breaking out in 2003, a Square breaking out in 2017. I see that in ELF this year. I see that in CMG before it doubled and tripled. I see that common thread. So make sure when you study whatever aspect it is, that you're trying to study in the markets, be it dividends, as simple as dividends, be it Peter Lynch approach, be it Stan Weinstein's approach, be it William O'Neill's approach. You just dig deep into that and you try to find the commonalities of what happened in the past and what you see you could connect to the current state. 3 is collect thousands of examples, right? As much as possible. So if there's some data, at the end of the day, we function best when we see repetition and patterns, be it when we look at buildings in a way, right? Or we look at, just our eyes, our minds and our eyes are kind of built to see different, shapes and forms, and we relate to that a lot better. And when we collect, let's say 1,000 examples of certain charts, and when I say thousands, I sometimes literally mean thousands. right? If you want to build a stage 2 model book and you say, hey, 10-week goes above the 30-week, and when this happens, the stock goes into stage 2. Well, I'm going to build my whole framework around stage 2 trading. And you build, hundreds and hundreds of examples. 4 is become a subject matter expert. So whatever it is that you choose, I will follow the news and I will do this. I will look at Fed policy and that's the only thing. I'll look at dividends, I'll do that. I'll look at technical charts and I should only, whatever it is, or I'll look at a bit of fundamentals and a bit of technicals. Try to dig deep into that and try to be the expert of that, particular topic. I see a lot of people look at, hey, ROE. William O'Neill said ROE has to be above 17. I need ROE above 17 on all my stocks. There's no level of understanding why. There's no level of understanding on what ROE even means. There's no level. I'm just picking on ROE, but any aspect of what you're doing, if you're not understanding and you're not fully consuming that, right, and you're not, making sure that you understand that aspect, you're doing, that's how your confidence, your self-confidence will, lower as you add more tools to your trading. So be the subject matter expert of whatever it is that you choose. If it's dividend markets, if it's insider, reports, learn why Nvidia's CEO is selling. Is it scheduled? Is it not scheduled? Is it ahead of time? What's happening? A lot of people don't just understand why it's happening, but it's very trendy and sexy to say, hey, there's some conspiracy theory going on. We need to know what's going on, type of thing. So learn those things, learn every input of your system and make sure you're comfortable with it. Find common threads, collect thousands of examples, zoom out and look at the bigger picture of what you're doing and become a subject matter expert. And I promise this is the last slide on mindset, but there's one more. So habits, routines, and lifestyles. So we spoke about, we need to have this mindset of stage 1 and 2. Our mindset is based on the fact that we need to stop losing money. But I think habits, routines, and lifestyles play a big part. Just balance things, take it as a journey, take these steps over a span of months, quarters, and years. Don't burn yourself out. If there was instant success and some service that existed, I would list it right on this page and you could just go and subscribe and we'll all be happy. There's no need to do 7 webinars and be realistic. There's no such thing as that. Good decision-making comes from good sleep at the end of the day. When you make rational decisions, when you don't sleep enough, you're likely cranky, you're annoyed by anybody, everyone else, and you're not making good decisions. And humans tend to make bad decisions when they're in that state. And that comes down to your lifestyle has to be proper. Your mind, the way that you come to the desk, there has to be a positive mindset around you for you to make really good decisions, right? In the markets, you're being paid to make decisions. And if you can't, balance your lifestyle and there's something going on, get away from the markets, fix whatever it is, and then come back because the markets are never going away. And I guarantee you that the NYSE is not closing, at least in our lifetimes. So habits, routines, and lifestyles matter quite a bit. A positive mindset, surround yourself with people that will boost, your morale. Surround yourself, so that when you come to the desk, you're making decisions and the market is rewarding you for making good decisions. So those are the 3 pillars of success. We discussed the first one, and that's the mindset. Let's pause here a little bit because I'm tired of talking, but Richard, go ahead. Add to this.
No, I think we've covered it. And like Rai said, this is kind of the important stuff. This is your foundation that you're going to build your system upon. We're going to dive into the edges and setups and frameworks around that. But if your mindset isn't right, you're going to burn out. You're not going to be able to continually improve and work on something. You won't be able to find new edges if something stops working for you. I think it's really important to build your foundation with that mindset and know the reality, right? Because people think they can start trading in a week and they'll be making $1,000 a day, and that's just not the reality. You're going to have to work on this over time, continue to learn lessons, experience different market cycles, and your mastery in this field is never really done, right? You're always learning. There's always something new, a new edge that you can develop or tweak to your system, to your process, all of that. So, yeah, I see some thank yous in the chat. So, yeah, I think we can move on to the fun stuff now. Now that Rai's given us that great lecture. So, yeah, I think let's move on.
11 o'clock.
It's 11 o'clock.
So,
Yep.
awesome. So edges. Let's dive deep into the second pillar, right? So what is an edge? So we'll draw some inspiration from Mark Douglas. He's written 2 books, 3 maybe, that if you haven't read them, I think reading books is a great thing. You get to look at different systems, how different people think, right? Even if it's a book on day trading or a book on completely, towards investing, building your knowledge keeps your brain pretty sharp. But what you don't want to do is, hey, I want one setup and I'll wake up and look at charts all day and just go back to sleep. I think we need to keep our brains sharp and always be a little bit curious about what other people are doing, how did they figure it out. And this quote from Mark Douglas, Richard is going to read it out and then we can discuss it.
Yeah, sure. An edge is nothing more than an indication of a higher probability of one thing happening over another.
So at the basics, or at the root of it, an edge is, what Mark's trying to say is, it's not a guarantee, right? It's not a guarantee of it will always work as we execute upon it. There are no guarantees. If it works 4 out of 10 times, it's still an edge. If it works 3 out of 10 times, it's still an edge. The best traders, the win rate doesn't have to be 8 out of 10, 9 out of 10 for you to be successful, right? And our mindset has to be of that nature as well. What we tend to do is, if we describe a setup and a particular edge that we have in the markets, that edge works in certain markets and it doesn't work in another market. And that's perfectly fine, right? But if we box ourselves in and say, hey, how do I increase my probability from 3 out of 10 to 4 out of 10? I see that when the market is doing this, if I just avoid this type of market, my output increases from 3, my win rate increases from 3 out of 10 trades to 4 out of 10. That's a huge difference that you can make to your equity curve. That's a huge difference over a long span of time. If you do 50 trades, that makes a big difference at the end of the day. So what Mark's trying to say here is, it's nothing more than an indication that you're just a little bit more successful than you're not. And that's what an edge is at the end of the day. Again, people tend to think that an edge is, hey, it has to work 9 out of 10 times, and if it doesn't, it's not an edge. Let me go to some cloud formations on technical charts, or some new system that I can get closer to 8 or 9 out of 10 times. That seldom exists. Those signals, I'm telling you, 3 out of 10 is really good. 4 out of 10 is amazing. 5 out of 10 is out of this world. 6 out of 10, you should go and make it proprietary and make sure you don't share it with anybody else. So let's go on to the next one. This one talks about, Richard, go ahead and.
Yeah, sure. And yeah, I was going to reemphasize the fact that an edge doesn't mean it has to work 8% of the time. The majority of traders, they're looking for positive expectancy, which incorporates, if they're right, how much do they make when they're right? If they're wrong, how do they lose when they're wrong? That's a key factor that's incorporated in edge as well. So here we go. Why do casinos make consistent money on an event that has a random outcome? Because they know that over a series of events, that's really key, a series of events, the odds are in their favor. They also know that to realize the benefits of the favorable odds, they have to participate in every event. Yeah, this is a great quote.
So this quote, like you said, a series of events where they know that they have a positive expectancy and they know that they will eventually be on top of that, at the end of the day. So they've built a business and a model that's just based on that. And people go there for, it's more about having fun with, family, friends, etc. But that model is just, we as when we place a trade, we don't know what the outcome is going to be. We place a series of trades And we know that as long as we know that the odds are in our favor, we're going to have a favorable outcome at the end of the day. So casinos and traders, how they operate are very similar. That's why people draw analogies, blackjack analogies, and all of that stuff, because our framework, if it's strong, and we know over a series of trades we'll come out on top, one loss is not going to put us down. 5 losses in a row are not going to put us down, because we have some level of confidence that we've built, that when we see this through, we will eventually come out on top, even though in some cases it might be just $1, right? So let's keep going with what is an edge, right? So now we will try to specialize our discussion. Enough of the big talk and like the, how what different people do. This is more about how we can kind of apply some of these concepts and really specialize and become subject matter experts. So what is an edge? It's from a technical perspective or a fundamental perspective, it's a winning characteristic. What is a winning characteristic? It's something that stocks in the past, over the last 50 years, when they've moved double, triple, and then some, or stocks that have gone down 100, 50, 60, 70% off of their highs, they've exhibited these characteristics. What you want to do if you want to build an edge in the markets is you want to find that winning characteristic. That could be Bollinger Bands, that could be Fibonacci's, that could be MACD's, that could be RSI on monthly going above 70. That could be anything. There's hundreds of different ways, but define that winning characteristic that you see. That, if you're a bullish trader, this is what stocks are doing when they double and triple. This is what stocks are doing when they break down 50, 60% off of their highs. You define that and you just have a list of those, right? And that applies to any system, any trader, any successful Minervini, VCP, 2T, 3T, and all of that stuff, right? What is it? It's just tightness in price formation. He's seen this winning characteristic where contraction and volatility leads to expansion in price, be it north or south, right? Up or down of that from that contraction. And that's a winning characteristic he's designed for himself. And he's continuously exploiting the market to see the same thing again and again and again. But he understands why. He understands every stock in the past that either I've been successful, he's been successful on, or as a technical trader, I see that's a winning characteristic he's exploiting. At the end of the day, that's what an edge is. It's a winning characteristic. We need to continuously exploit this again and again and again to increase the chances of our positive outcome, right? There's repetition in what these successful traders are doing again and again, and that increases their chances of positive outcome. Prior leadership stocks have exhibited these characteristics. So we learn from what's happened in the past in the markets, right? We learn that, when Square in 2017 had a HVE, when Facebook in 2013 had a HVE, when Google broke out from its IPO base, whatever it is, all of them exhibited this one characteristic, which we'll discuss, which is the highest volume characteristic, right? Highest volume ever, highest volume since IPO, etc. So prior leadership stocks that seem to double and triple have some sort of, this characteristic. If I'm a day trader, Bollinger Bands seem to narrow down, right? And the standard deviation of how the stock moves, basically it's tightness, it's a measure of tightness, seems to squish together, and we see volatility and the bands, come apart, saying that from tightness, from contraction comes expansion. It's a very simple concept, and it's been given 100 different names at the end of the day, but it's a characteristic of how stocks move in the markets. Hunt for these characteristics in the current market. So if you have, for example, let's say, just build a OneNote, right? Microsoft OneNote. Hopefully we'll have it in Deepvue one day where you could just build model books super quickly, but Microsoft OneNote, for example, open a tab, name a characteristic, and say all of these stocks are they're exhibiting these characteristics. I'm just going to keep track of them. You keep track of that stuff, you'll see how they play out, and your subconscious, you're building that knowledge in your subconscious, right? And traders that are successful, they execute that edge repeatedly. They're repeatedly doing the same thing again and again. Minervini's built a whole system on VCPs, right? And he sees accelerating growth and sales, which is drawn from William O'Neill's system. Then he combined Stan Weinstein's stages and described stocks, and he combined 3 successful systems into his own system, right? And it was drawn from William O'Neill's stage analysis and a little bit of himself at the same time. So he built some repeatable patterns and characteristics that he has to watch for, and he studied them by himself. He didn't say, hey, William, I trust William O'Neill. He says ROE is greater than 17. I must use this or else I'll never be successful. None of them think that way. They think the opposite. They say, this is what worked for William O'Neill. When I try this, it's not working for me, but this aspect of his system seems to work. Let me steal that aspect and make my system even stronger, right? So traders and investors must do deep dives on these characteristics to build self-confidence. Self-confidence, self-studying is key because you have to go out there and execute those things for yourself. And that all comes down to spotting some sort of winning characteristic. Brian Shannon says the 5 EMA is declining. I don't buy stocks below it because that's what works for me. When the stock goes above the 5 EMA or the SMA, it works, I have a positive expectancy in the market. He's identified a winning characteristic on the shorter time frames that work. Those work for him. And he's repeatedly executing those to profit from the markets. No matter what system you pick, fundamental, technical, this is what they're doing again and again and again and again. So define those characteristics for yourself, maybe list them in the chat. What do you look for again and again in the markets? Try to, specialize to that as much as possible. Traders tend to have 3 to 4 that they look for, and they repeat those things. And then, they try to, you could say, hey, stocks are accelerating, sales and big estimates seem to move. That could be a winning characteristic, and you only trade those type of stocks, right? So they try to specialize as much as possible. So after this, I think we'll pause. Any questions? I would love to hear some of the characteristics that people look for in the markets today. I think that would be very cool to see in the chat. So let's say name a characteristic you're looking for in the markets, right? So stage analysis plus relative strength, tight areas and breakouts with volumes, Minervini, SEPA, KMA launchpads, moving averages, nice, volume edge, perfect, tightness, buying near all-time highs, seems to work in some markets it doesn't. Momentum, longer base breakouts, expansion, contraction, volatility, contraction. So I see a lot of, you have these defined, and that's a really good starting point, and that's what places you in stage 2 or stage 3 at the moment. Stage 1 traders don't even have this. So you're well along, in terms of what you're looking for, in terms of a characteristics that you see in winners again and again. So that's a huge positive.
Yeah, and
so
Ryan, let me ask you, all these that are being listed, how much should traders specialize in just a few of them, like at this stage in the game in stage 2?
So I would say, at stage 2, I think, stage 1 is you're curious, you try different things, you fail at all of them, and then stage 2 is a transition to here's a subset of things that work for me, and now I'm specializing a little bit, right? It's still okay. I still place a VWAP on my charts just to see, because I see Brian Shannon using it. I see a lot of institutions talking about it, etc. Right? That doesn't mean I have to incorporate that. It doesn't mean that's the only way I should trade. But I'm curious about it. I will put it. Will I make decisions on it until I'm comfortable? Likely not, right? I will not do that because I haven't built that confidence for myself. So I will try those things. I think it's good to try these things. It's good to kind of look at these, different aspects. I read a lot of books. I think this one's a good one by Jesse Stein. I don't know if you could see it, Insider Buy. His approach is completely different to William O'Neill's stage analysis. He's trading on sentiment, right? When things get too stretched to the downside, how do they go up? How the 200-day plays a big role in the markets. And he's just seen that again and again, right? So I don't know what your question was, but I hopefully answered that.
Yeah, it was more like, as a stage 2 trader,
yeah,
how many of these edges should you really be focused on? Obviously, you try different things, but yeah, that was kind of my question.
So let's just talk about like a successful. Let's talk about Oliver, right? Oliver's book that came out is listing a framework on the markets where he says this is a wedge pop and this is a price cycle of a stock that he's gone through. He didn't come up with that one day. He just woke up and that's in his brain. That's a refinement, right? Over a span of time through different systems. He went out and studied stage analysis. There's some inspiration from that. he went out and studied the book on Japanese candlesticks, drew inspiration from that. And he was curious about all those things for him to get to stage 3 where he is today. So I think stage 1 and 2, you have to still look around and kind of see, what are other folks doing? But when you get to stage 3, it's almost like we know traders that have been using TradeStation for 3 decades, right? And they're never gonna go away from that, no matter what. So they're in that stage 3 mode. They know what they're doing. They know the screens that they're running. Their curiosity level after 35, 40 years is now kind of done, right? And they just wake up and they have a very specific routine. They might be curious about stuff still. They might read different things. As the market becomes faster, what does Stan Weinstein say? I pay more attention to the 50-day now, right? I'm trading more on the daily because the market has changed. So they refine themselves again and again and again. I think that never ends, but stage 3, when I try something and I fail, I go back to what I know, right? I know that this works. And I know when I operate back in my little cave, I function much better after I lose my confidence, after I try out a whole bunch of things. I come back to that. So you'll have these core edges that you always operate upon, and you come back because they give you confidence because you've done all the homework on them. And then I'll place a VWAP and see if it works. And if I make a decision based on VWAP and it doesn't work, and then I go back to what I know works for me. So there's a lot of shifting. Even stage 3, it's good to be curious. It's good to maybe throw on something new and take a look at it, right? At the end of those 2 things, self-confidence in what you're doing, collect 1,000, or examples, hundreds of examples of what you're trying to do. Those things at the end of the day will allow you to incorporate things where you can communicate with nobody else in the world. You come back to what works for you and gives you, enough ability to go execute that. So
yeah, perfect.
Perfect. So let's get into edges. Let's discuss the first one. So this is a winning characteristic. Like we said, this is something that repeatedly happens on the charts. This is if you follow me or Richard or TL or a lot of different people on social media, you can call it whatever you want. It doesn't really matter. But this is the high volume edge per se. So there seems to be a consistent way young stocks that mature over time, stocks that have earning surprises or some catalyst or some new information that's catching the market off guard. There seems to be a big volume bar at the bottom of the charts, and there seems to be big price action with respect to the candles that they put up. And this has happened in Facebook, Square, Google, Apple, any company, Netflix, ELF, CMG, ISRG, any company that has had a trend, right, has had a large trend and is trading tightly, has good price action and volume, etc., seems to if you put a wider net on them, you could say maybe 70% of them exhibit this and 30% maybe not. They don't. That's fine, right? We're not saying this has to happen for a stock to be a leader, right? So 60 to 70% seem to show this, and I classify, and I digged a little bit deeper than most people, and I classified that, hey, I see if it's the highest volume that a stock has ever traded, this seems to be a little bit more special than just calling it, hey, this is high volume. So I just quantified it a little bit more, dug a little bit deeper. So I look for the highest volume ever and the highest volume since IPO as my top 2 winning characteristics that have made me the most amount of money and the most amount of progress that I could possibly make in the markets. The other 2, highest volume in a year and highest volume since last earnings, they seem to be a little bit of more so short-term momentum in stocks that are acting well. And that's another, these are just variations you come up with as you continuously trade the same setup over a span of time. The rationale for this is it's visible accumulation on the charts. The rationale for this is historical winners in the market that have moved 100, 200, 300, 400%. seem to show this, even if you feel like you're late to the party when they exhibit these, they seem to double and triple from that point, right? They seem to move after they've put this characteristic up on the chart, they double and triple from that characteristic. So there's new information, market is caught off guard, there's catalyst, there's earnings, related, news related, upgrade, downgrade related. So there are different ways that this characteristic seems to happen in the markets. So let's get back and take a step back. So we talked about the high volume edge, and let's see if it meets your checklist. It's a winning characteristic. Why? Stocks in the past have exhibited this. It increases the chances of a positive outcome, because if stocks in the past that have exhibited this are going 100 and 200%, I've identified my winning characteristic. It increases the chances of me having a positive expectancy over a series of trades. Prior leadership stocks have exhibited this. I can execute upon this repeatedly. It's a pattern that I watch for, and I can make that pattern a source of income. I can make this winning characteristic a source of income, which is eventually what an edge is. I've studied it by myself, and I have hundreds and hundreds of examples that I can refer to and how those stocks tend to move. And I've done the appropriate deep dive to master this setup so that I can trade it by myself and not be dependent on anyone else for it. So let's get into some examples. These are some historical examples and old drawings or charts that we have. The first one being, this stock gaps up. Many of you will likely know which stock this is. This stock gaps up, puts in a bar, and something has happened. This was an earnings catalyst, and the volume was highest in over a year. This is 40 million shares being traded, and there's something that's happening in this company, whatever the case might be. But this is the winning characteristic that I'm looking for at this point. If I trade this over a series of 50 HVs, for example, I will have a positive expectancy in my equity curve. Same thing with this. We have the highest volume ever on this particular name, whatever it is that happened on this gap up. The company then goes from about 35 to 57. Again, it gives me a chance that if I were to just track these and this particular characteristic that we're talking about, then I can have a positive expectancy in the markets. So there's some more examples over here. This is the highest volume since IPO. This is the highest volume since IPO day, and there's follow-through volume. This, you'll remember, is UPST. This, I assume, is an IPO. For some reason, I don't remember which one, but it gets the point across, right? We're looking for a characteristic, and let's get into some live examples of this, Richard. So I will go to our screener. We have put together a list of examples that we could talk about live, just to give you guys a look at some of the recent ones. And I really want to dive deep into what these are and what some of the examples are in recent times, to give you some visual evidence as to how we could trade these. So first example, Richard, let me know if you can see my screen.
Yeah, I can see it. And before you get into, there's a question from Manuel. What's the best way to scan for volume and scan for these edges that we're talking about?
You could use pretty much any scanner. Obviously, I will have a bias because heavily involved in Deepvue. Deepvue, we have presets, so you could look for highest volume in a year, highest volume ever, highest volume since IPO, and highest volume since last earnings. So all of those are configured in Deepvue already. But you can scan for these. You should be able to scan for these on most platforms, anyways. So.
Great.
Any other questions?
No, I think let's dive in, and I'm sure some will come as we go.
Okay, perfect. So this one is, ANF, it gaps up. There's some sort of catalyst that's happened. And then if we zoom back out, this is the highest volume the stock has seen in over a year. So there's something that happened at this point in time. The stock's gapped up to that point. And then if we zoom in, the stock puts in a high closing range. And this thing's gone from 30 to about 55. So the first step to having an edge in the market is to identify a characteristic that continuously repeats on stocks that seem to be moving up. And that's literally the first step. And people will skip steps here and say, where do I enter? What do I do? How do I do this? How do I set an alert? Magically just enter the names. That's a discussion for another webinar that we'll get into, the very specific entry tactics that you could use. But that's the first step. That's as we build these frameworks, the first is to identify some sort of characteristic that seems to work. So this is just, let's generalize a little bit. This stock, as it gapped up, moved from 30 to about 55 in the short span of time. Here's another one, APP. It's kind of the same situation. This volume was the highest volume in over a year. The stock was in a downtrend, right? It gapped up, but poor closing range comes back in. And then this gap up over here seems to function. The difference is the market was not good over here, and the market kind of turned around over here. And this stock goes from 20 to about 40 from May of this year to September in a short span of time. How did this start? This is the highest volume in over a year, which is HV1. Let's go.
And Right, can I jump in? Yeah, I know we won't dive too deep into this, but can you touch on maybe the entry tactics that you'd like to use after these HV edges? Personally, I like to see a range form, a tightness. I'll also play the HVC, especially if there's a tight range around that. But how do you primarily trade these type of setups?
So there's three things that you could look for. One is you could be a day zero, which is day one, it gaps up, and you look at what is the earnings surprise on this. What it has a company done that's causing this gap up. That's one edge. In this case, you could see there's not much of a surprise and not much of sales growth in terms of what they're doing. The second is I tend to wait for day two, right? I feel most comfortable. I don't care. At the end of the day, you have to be comfortable with risk. And for me, I can define my risk a lot better on day two. There's three things kind of I look for on day two. Volume support. So you zoom in on this bar and you look at 15 minutes. Where was the bulk of the volume on this day? And if that stock comes back into that area, I can minimize my risk and operate based on that, right? The second, like you said, is the HVC area, which is the highest volume close. Is HVC is highest volume close. And then the third is the high of this bar. So if it takes out the high of that range and continues higher, I want to be involved. And those three areas give me enough, from an entry tactic perspective, a way to manage my risk tightly and see if we get some momentum out of this. Or in this case, it goes up, comes back in, acts as support, tightens up. Our expectation here is 2 down days on increasing volume. What's the expectation? The expectation is this is going to go lower. It didn't. It broke that expectation, tightened up, and then continued on higher. So that's what we discussed in kind of webinar 1. If you were to just track this, hey, the stock has a 45% closing range. I expect some sideways to down action. Perfect. You got sideways to down action on this day. What's my expectation? The volume wasn't as high, right? Still above average. I expect more downside action on this. The next day, what it does is it puts a bullish bar on increasing volume. My expectation here change. I said, I'm going to say that this is going to go up. This is either going to go sideways and up. We get sideways and up action. This is going to go sideways and up. We get a gap up. And then over here, you could say, hey, it gapped up on high volume. Let's not get into that. This is like a bar by bar analysis of this name, but those are the three. I hope I answered your question. Let's keep going.
Yep.
So here's a historical one that Richard wanted me to talk about. Richard, do you know when this one gapped up big? I think it was.
Yeah, it was in May of 2020. Yep, right there.
Right there. So what's different about this bar versus every other bar, right? If we take a look, let's just put this over here. This thing, this happens. And when we look to the left, and let's zoom out as much as we possibly can, we don't see another bar that's this big. We don't see another bar that's this big. We still don't see it. We still don't see it, right? So there's something special about this bar that's something's happened and it's caused a stir in the markets, and it's traded 18 million in volume in a single day when this name doesn't seem to do that often. So this was the highest volume ever, and this is what happened after the fact. So we identified a characteristic that has consistently yielded winners in the market, and this yielded a winner from about, just take this, let's just take the high, even $9, and let's take the low here, $30. So 9 to 30 based on a single characteristic. And I see this in the market again and again. And that is one of the edges that you could, incorporate into your system and operate upon as well. How do you enter these? What markets are good to enter this setup? That's a different conversation. Again, we're at the second of the 7 frameworks. We'll get, deeper and deeper into this. The first step is please identify a characteristic that works for you.
Yeah, but sorry, just to go back there very quick, unless it's going to jump all the way back. It's going to jump all the way back. I was going to say, Rye might enter that setup completely different than I would, but that same edge can be in play. I'll look for the tight areas where it's more VCP-esque, it's declining on below average volume. So Rye might look to enter on day 2 or day 3 there. It kind of reconfirms. But if you move forward, there's a lot of tight areas where my kind of specific entry tactic would work quite well. If you, keep it right there. Yeah, right in here, or even, it goes and forms a base. You've got a horizontal level there. It forms a tight range here against a 21 EMA. That's like my favorite absolute entry tactic. So these edges, you can hook them up with your specific entry tactic that makes sense for you, where you can manage risk tightly and you can know very easily if you're right or wrong. That's kind of the commonality that you want to look for. So that's all I wanted to say there. We won't dive too deep into that because we'll be here literally all day. So yeah, Arlo, let's move on.
Arlo. So this one, again, a company, inspired by Ring, they do equipment, security equipment, etc., had this bar of 15 million in volume, and the stock then consolidates. And I remember having a conversation with our team. I said, this looks exactly like AEHR when it was at $5, right? This looks exactly the same, exact same consolidation, exact same characteristic. If we're going to have a good year in the markets, this thing's going to double. And that was not, I have some superpowers or something. That was just, this thing looks exactly the same as this other stock that I may have missed in the past, and I don't want to miss this again, right? And you take that, and this was the highest volume that this stock has traded in over a year, and I think ever in its history, and it's stuck out like a sore thumb. And it was a characteristic you identify, and this thing moved 2 earning cycles from about $5, right? Tightened right around $5. Again, Richard said he might not enter right here. He might enter where it's super tight. Look at this. This is super tight. We'll talk about entry tactics and get really specific, but you can manage your risk here, and then you go from 5 to 10. And all you did was identify a winning characteristic in the markets. Let's look at CPLX.
I just want to jump in. I think you texted like every single day that it was moving. This looks like AHR because you're so in tune with connecting the current state to this past one, and that was your focus, right? And that's what's going to allow you to identify these characteristics over and over again, is studying the setups and studying the characteristics and making a list for yourself and a mental image of what to look for.
Yep. So CDLX. Same thing. There's this big bar with 68 million in volume, right? And there's something that's happened. The stock's in a big downtrend, comes in like a waterfall, right? And then all of a sudden it's jolted, whatever the case might be, right? And this thing, if you just keep it on your radar, right? This looks like, not the easiest one to trade. And as Richard says, you wait for your setup. And I think, it's got most tightness right here, right? So it got very tight right here. You can manage your risk. And then this thing moves from, let's just take the high of this, $6, and the low of this, $16. Allows you to have this on your radar and at least give you a chance based on a single characteristic that you identify. Let's look at CELH.
There's a question that I think is a good one for CDLX. How long do you keep a stock with an HV edge on your radar? How once it has that edge, you know, would you keep it on there and keep watching it for a month, 6 months? What do you like to do?
I have a dedicated watch list and I will place them on there. It cost me absolutely nothing to have a watch list with all of these, right? And I will review them. I tend to do it daily. You don't have to do it daily, but you could review this weekly just to see what's going on, right? The list in certain markets will be a lot bigger because there's so many stocks doing the same thing. And in some markets will be a lot smaller. That tells you just from a risk appetite perspective, there's 35 gappers at the moment that I'm tracking. It's a pretty good number, right? In a bad market, you will not find any of these. Nothing's gapping up on high volume in a bad market. So maybe the reverse of it, right? People call it the reverse peg, revert, the highest down volume in a year, highest down volume ever, highest whatever. Those seem to work in a downtrend. I tend to maintain the upside, and there are 35 stocks. So if you feel like, some of them you as you trade this and you build instinct and you look at this and you say, hey, this seems to be a biotech that is, has done nothing, and it goes from $1 to $9 in a day. A lot of people come back to me and say, hey, that's a HV. Why aren't you trading that? Well, I'm not that, insane yet, where a stock moves from 1 to 9. There's no way to manage risk at that point. Or it moved on some sort of news, it gapped up on some sort of news, and there's still no way to, manage your risk. Something like a CELH, when it gaps, has good, fundamentals to back it up, has good technicals to back it up, has a good story. There's some elements that you need to surround. It's not just, I have an edge. BBIO has moved from 1 to $9. You told me this is an edge, and that's a binary approach. We'll get into the entry tactics and qualify these as good ones and bad ones in a little bit as well. So let's take a look at CELH. What are we looking at, Richard?
I think it's the 2020 gap, right? You picked this one, not me. So
I'm talking about this gap.
Yeah.
Right here.
Yeah, so that was right before that long base. So you're already looking at that if you want to go to the daily.
Yeah, so let's look at that on a daily.
Yeah. So in the chat, leave right now, list out the edges that you look for, as well as your setups that you like to use.
Let's keep it on the weekly. I remember trading this, and I'll tell you guys a pretty good story. So this one had the highest volume initially over here at $6, and it had this particular gap, and it did nothing until the next quarter, right? It did nothing. All it did was frustrate the heck out of everybody. It was downgraded on this particular day. I still remember that week. It was downgraded, and it didn't break its range. And this thing eventually had a monster run from 17, and it's trading at 200 now, but this was the highest volume in a year, and the highest volume ever, and the highest volume since IPO. And it consolidated, it frustrated, but then it put that in again, right? Highest volume. This one was bigger. This was bigger. This was the highest volume ever. Again, a stock that trades at 200 right now exhibited this sign at 15 and at 20, right? And this is not the only example. So again, a winning characteristic that you identify. Let's keep going. ELF. This one is a beauty in terms of how this has moved over the past couple of quarters. So let's take a look at this day. Yep. Even if you pick this up at 50, you're giving yourself some sort of chance to go from 50 to 105, right? So this gap, highest volume in a year. This gap, highest, qualifies as the HV. This recent gap qualifies as an HV, and now that we have this one, which was a poor closing range, so it needs to come back in, do whatever. Now it's a little bit late, right? We've gone from 50 area, which is the high of this bar, to the low. Let's just take the low of this to 115. So this has moved quite a bit at this point, but it gives you a chance. If you were to just track this characteristic in the market, it gives you a chance at the end of the day to have this type of run. Let's look at Uber recently. Uber has had a lot of these gaps on HVs, and then we see a character change, like this tightness after the gap. which we see in the RMV. That's a whole separate discussion. I'm kind of, fascinated by it, but this tightness after this gap is a lot different than how it traded over here. There's a lot of bigger spikes in terms of volatility, and this has moved from the high of 36 to about 50. A little bit of a slow mover, has higher flow, right? So it needs to carve out. It's kind of like an AMD type of mover, right? Has a bigger float in the market. 2.04 billion shares are available for trade. So it moves a little bit slower. But again, you track that, that's the highest volume, and you go from 30 to about 50 for a basis. Same thing with BRT. There's not, these stocks just don't move without the signature that we're seeing. So this initial gap, maybe you don't catch this, it gaps up, poor closing range, you kind of ignore it. You can't ignore it over here. This is higher volume, right? Poor closing range, but acts well. Expectation was this is going to come in, breaks the expectation, trends above the 10-day, all the way from 18 to 26. Then it rewards you because you kept track of it from here, gave yourself a chance. And if you got this run, you could definitely held it through the earnings, and it gaps up to 30. So we're talking about a stock, let's just say from 19 to a low of this 37 in this recent, run that we've had in the markets. And these are just 11 examples that we've gone through. Let's go through like Piton back in 2020. How did the Piton run start before it doubled, tripled, and then some, and then gave it all back? Same characteristics, exact same characteristic. So we see this Piton IPOs, right? 2020 COVID happens, comes back up. This bar here is the highest volume the stock has traded since IPO, and the highest volume ever right here. Obviously it consolidates a bit, it's not tight enough. It has a rash action, but it tightens up eventually, and then we go for this epic run. But it all starts from the fact that I did not trade this, right? It was on my radar, but I did not trade this. I did not trade this run, but it gives you a chance, right? You catch 3 out of 10 of these. You catch, 10 out of 30 or 10 out of 50 or 12 out of 50, whatever the case might be, over a series of time. If you just keep track of this characteristic, you give yourself a chance, right? You're giving yourself some sort of chance, just maybe I will catch this stock to the upside. So these are not guarantees we're making. We're saying if you catch 3 of 10 and you keep your probability at that, let's just say, or even 2 of 10, the one that you do catch and that one doubles and triples could have this potential run to the upside. So there's many others. I mean, we could go, all day. PLTR's initial run from IPO started from this, this right here that a lot of people talk about.
Yeah, and this is an example of an edge. You can adopt this and study it for yourself, or you can start to notice the characteristics that your common winning trades have and look for more of those. The thing is, you want to build a framework around what you're doing, list out your edges, make a checklist, know what to look for. All of this is trying to become more systematic, more repetitive, so your inputs are consistent, and ideally that helps you improve your outputs over time as well, and just try to improve and improve and improve. Yeah, this was recently we had off the bottom. Yeah,
so highest volume in a year, consolidates, makes, again, entry tactics we'll get into. This is follow on, follow through volume, goes on a big run. This thing's doubled from 9 to 20, so 10 to 20. Now it's resting, but it gives you a chance, right? Even if you caught a percentage of this run and you sold all of it here and you never got back in, this thing gave you a chance, at least, have it on your radar, see how it's acting, correlate that with your entry tactics, which we'll get into in subsequent webinars. So I think we beat this to death, right? It's identify a characteristic, collect hundreds of examples, allows you to repetitively operate in the markets again and again on that, and changes your expectancy of a positive outcome as a stage 1 trader to a very minimum at a stage 2. And then when we combine this in subsequent webinars with entry tactics, how do we enter? How do we minimize risk? How do we operate? That will take you from 2 to 3. So let's get back, Richard, to the slides. So share, present.
You're still sharing. I think you can just switch the tabs. Oh,
No,
there we go. Yep.
I paused and switched.
Cool.
Yeah. So, but any questions? Any concerns? Anything that is not making sense? We don't have any questions. We're just doing an incredible job.
Yeah, there's some questions about entry tactics, but like Rice said, there's a lot to cover, and we'll cover that in a future one. Joseph it makes a good point. Notice the character changes in the stocks after these gaps. Prior, they trade like shit.
Joseph's been trading HPs for what, 3+ years now. So he's figured it out over a span of time, right? So he's been trading these for 2-3 years.
Yeah. And after institutions continue to control price action accumulating. Exactly. Perfect.
Yeah. So the longer you try to specialize in something, right? And I'm trying to get this into your guys' heads as much as possible, right? The better you will be. The better you will be at identifying, the better you will be at trading these. The first step is identifying, and that's what we're covering today. The second one, Richard, if you want to cover this, my throat's kind of.
Yeah, sure. So relative strength edge, we just did a recent webinar kind of completely about this and kind of what we look for. But, very plain and simply, we're looking for stocks that can outperform, and they leave clues, especially when the market is coming in, whether it's a longer bear market or correction, that we can notice and keep track of so that they're on our watch list once that correction is over. So we've got a few listed here, relative strength, new high before price. That's when looking at relative peaks. Maybe the stock isn't making a new high, but the relative strength line, which is just the ratio of the stock to the index, is. And what that tells you is the stock is holding up a lot better than the market, a lot better than all other stocks. And it's showing that outperformance, showing that accumulation by institutions. And when that market pressure lifts, that's when it can take off. RS zone, RS phase, this is where, the stock is in an uptrend, the RS line is an uptrend, another key characteristic that we look for. And RS days, right, that's kind of your specialty during corrections, counting the number of days where the stock on a relative basis is outperforming. Maybe it's even down, but it's outperforming in some way. And I think your study said over 61% of days, that's what you're kind of looking for.
60 to 63%. If a stock is exhibiting relative strength 60 to 63% of the time while the market is officially in a corrective phase, let's just say breaks 21 day, those stocks tend to be the leaders on the next cycle. That's just the stat.
Yep, and Purvish says 61.8 is a fib number, so who knows?
The universe revolves around that. That's a whole.
Yeah. So the whole rationale behind relative strength, and some people say relative strength, by the time you notice relative strength, it's over. I completely disagree. I think you just have to look for the subtle signs, right? You're looking for low down in the base when the correction is happening. You're trying to build a case for a stock every single day and trying to add different characteristics to it. So I think a lot of people in here are probably already familiar with relative strength. We'll maybe link down below the relative strength webinar we did. I think we can move on from here since we're already almost 2 hours into this thing. So, and we got a lot more.
Yeah, so here's some examples. The super obvious ones you will find in the 2020 market, right? The COVID crash or COVID pullback, COVID whatever market you want to call it, the relative strength line makes a new high as price trades below the recent high that we're comparing. This is one of the best signatures in the market. I know we researched Amazon. This is Amazon, by the way. We put on a position right through this consolidation and rode it all the way up from this 2020. And that's a simple, we're identifying what stocks are holding up as the market pulls back in. And it's as simple as that. And then you identify pivots, which we'll get into the depths of very, very quickly in the next webinar and framework. And then, you can then manage your risk. And then then people get into, hey, I'm in a winner. How do I get out of it effectively? We'll cover that as well in subsequent webinars. So this characteristic is the relative strength line is making a new high, or the relative strength line is going up as the market goes down. Learn to identify this characteristic. All it's saying is we're expecting the stock to go down a lot more than the market because the beta of this stock is 2x the market. It is not doing that. It is not going down as much as the market's going down. That causes the relative strength line to go up. I know folks that say relative strength line doesn't work. They don't use it. They have other means of identifying it. And all they're doing is quantifying relative strength in a different way at the end of the day. So, well, if hey, you put in a higher low as the market made a lower low. What is that? It's relative strength. The market made a lower low and the stock did not make a lower low, right? So it's just a different way of saying the same thing. If a stock is strong, if VRT is above the 10-day, as the S&P and the Qs are breaking, you can pull up VRT on your end. That's a relative strength. As APP is trading above the 10-day, as the S&P and Qs are below the 50, that's relative strength. As CELH is trading above the 10-day and the S&P are below the 50 and the Qs, that's relative strength, right? Those stocks that exhibit and don't trade with the markets, even though the market has some level of influence, always has some level of influence on every stock. They're not doing that. There's some level of accumulation that's happening. And that's most severe and mostly magnified when markets go into correction, right? And you could take that stat, stocks that exhibit 60 to 63% relative strength, right? As the market goes into correction are the leaders. SE did this, Zoom did this, Amazon did this, Roku did this, PLTR did this, just in the recent COVID correction. You go back number of trends, OKTA, Coupa Software, Squarespace, Square, those were the 2017-18 correction. You go even more back in time and you, let's say, get closer to 2015, all the steel stocks when we had a correction acted well, and some of the smaller ones doubled. The cannabis, so this is off the top of my head. You study these cycles, you know these things in the back of your head. If you don't do this for yourself and you're waiting for me to tweet it or Richard to tweet it or anybody to give you, some sort of help on Twitter, it's not going to work. You need to know these, over time as you study different market cycles. These are things that you just say at the end of the day. So we have another example. This one points more to the longer. I know this stock is AEHR for a fact, because this one had the highest volume edge, doubled, and then held around 5. Very similar to Arlo. It looks exactly the same as Arlo. If you were to take AEHR at $5 and Arlo at $5, this one doubled from there, and it exhibited. How did it get on our radar? It got on our radar with the highest volume edge, right? The next concept is, as the market came down, this held the 10-day. As the market pulled back, this continued to rise. And when you see this relative strength, even if you miss the HV edge and you can't pick it over here at 5, and you see that this stock held at 10, I traded it over here. I traded it over here based on relative strength alone, combined with my high volume. Now I have 2 edges. And when we get into position sizing, this becomes important, right? But this one continued to go higher from 10 to 20, 5 to 20, whatever you want to call it, but it exhibited relative strength. That's our second edge that we look for, or our second characteristic that we look for in the markets. So let's get into some live examples of this concept and see how the markets exhibit this. I'm just going to pull this up.
Yeah, and while Rye's doing that, leave in the chat right now or in the comments any questions you have about the RS Edge. We'd love to hear it. And again, we'll try to answer as many as we can. And there's a question from Parv, who I think it's a pretty good question. Do you look for RS in a sector and then find stocks in that sector, or just scan each stock individually? Thanks. I personally favor a kind of bottoms up approach where I'm going to stocks first and then I'll notice trends in the industry group and then the sector. Some people I know, Jack Alpha Charts, he likes looking at ETFs and favors a top down where he's looking at the ETFs, identifying which are showing strength. You can go either way, and I know Rye, you've actually got all your ETFs. They'll both confirm the same thing. Like, this past weekend, we've noticed strength in software, we've noticed strength in oil and gas, and the stocks are showing that. And that's why the ETFs are showing that. So you can pick it up either way. It's about finding an approach and routine that works for you, your time constraints, all of that. Top down might be a little bit faster for people who have less time, but you might not be able to find every single, the best opportunity in the group. It kind of depends on what you want. So I don't know. I think that's all I was going there. Ryan, anything to add on that, or is that good?
Yeah, I tend to if I scan for relative strength. So if we just go here and we go to technicals, we have these pre-built scans, relative strength 1, 3, 6, 9, and 12 month in Deepvue. I can go through these and look for stocks that are exhibiting this relative strength, new high before price 1, 3, 6, 9, and 12. I tend to do that, and it will give me a sign of which industry group is holding well, right? Another way I do this is I just have an ETF list. And if I take this ETF list and I sort it by AS score, and I say uranium is acting well in the market, software is acting well in the markets, cloud computing is acting well. This alone tells me in the last 20 days, what's going on? Where's the rotation? Just like that, right? It's a very quick way. Now I can, yes, dig into what's inside XLE that's acting well, what's inside IGP that's acting well, etc. People do it that way or the other way. Look at stocks and then come to the conclusion that uranium, software, cloud computing, oil and gas are acting well. You could do it both ways. It's more personal preference. As long as you come to the same conclusion, it doesn't really matter how you do it at the end of the day. So let's go over relative strength examples, and we picked a recent market just to showcase this. So CELH. So we know that if we go to, let's just go to the Qs, and the Qs are pulling back from July 23, or sorry, July 19. They're pulling back, right? They're off of their highs. They came back in, whatever. Let's go back to CELH and say July. What is it doing in July, right? So this stock came up. So if we take a relative reference of what CELH is doing in the markets, it also pulled back with the markets, but it gapped up from that point, right? So now it's outperforming. It's in a relative strength phase. We call this a relative strength phase because on a 21-day basis, CELH is outperforming the S&P. Or if I place the Qs on here, if I go to settings, go Q, right? And I compare this, CELH is outperforming the Qs on a 21-day basis, and that's what this is showing. This blue shade to the top side is showing that this is in a relative strength phase. Recently, as we saw turbulence in the markets, let me get rid of these alerts. I can place them on later. This 10-day CELH continues to go higher as the market pulls back in, right? So that's relative strength. That's relative to the market, relative to the Qs. The RS line continues to rise, even though the Qs are pulling in the QQQ. So that's one example. Very simple observation. Now imagine combining that with this HB, right? You have HB, then you have relative strength. You combine those, you increase your probability of having a positive expectancy in the markets that will yield an eventual positive return and increases your chances from going to stage 2 to stage 3. Just those two things alone. So let's talk about this. I mean, this ETF, same thing. It's a relative strength phase. It moved higher as the Qs came in. That's what the relative strength line is rising. So if I were to zoom in, I picked an ETF on purpose just to show that this concept is not just for stocks. It could be for ETFs as well. So whatever, this ETF is holding is outperforming the markets because the RS line is rising and in a relative strength phase on a 21-day basis. The components of this ETF are outperforming the markets. Lilly, LLY, is a good example. This one has a really good story now. continues to hold the 10-day, right? As the market was pulling back in and the relative strength line continues to rise. Got super tight right in here. You define your pivot, etc. We'll get it back. We'll get into those in subsequent frameworks, and then we move up and out from there. So VRT, Richard, I know we have another one in an hour, so we gotta be a little quick here, but VRT, same thing, continues to hold the 10-day, rising RS line, acting well. And same thing, you're visually identifying HV, highest volume, this stock is exhibited in the year ever IPO, etc. Then you start to track it, and there's a secondary edge. It's exhibiting relative strength. It's in a relative strength phase. It's outperforming the market.
It's 12 o'clock.
And what we will get into when we discuss position sizing is you stack your edges up. And as you stack your edges, your probability or expectancy of a positive outcome increases. And you can also position size that name a little bit higher than the other names that don't exhibit the edge, which is basically a winning characteristic that you look for in the markets. ZS. So ZS has been acting well recently. So it's in a relative strength phase on a 21-day basis. It's outperforming the markets, and it's now exhibiting relative strength as it consolidates as the market pulls in. The QQQ is trading close to the 50-day. The ZS is trading above the 10-day. That's also relative strength, right? It's relative to what the market is doing. Some people tend to not look at the markets at all. They say, you know, setup. All I need is a consolidation type setup, and if it moves, I'll do that. That's one way to do it. But if you track stocks on a relative basis to the market, when the environment is good, your probabilities of success are higher. That's just math. And when the environment is bad, your probability of success is lower. So relative to the market, ZS is outperforming. That's another example of relative strength.
Yeah, and here the group is acting together as a whole and showing RS together. And for me, that's kind of another edge that you can layer on. When the group is acting well together, that's going to increase the probabilities of a move individually into one of the stocks. So that's another edge that you can add to your toolbox. And Stan Weinstein, of course, mentions that so many times in his book and in the masterclass as well. All right. You're bringing back up the presentation?
Yes.
Yep.
So we got the presentation. Those were live examples of relative strength. There's study. So one thing you could do for yourself is just pick any downtrend in the market in the past and look for relative strength examples. It will solidify that concept, right? In the back of your mind when you're trading real time, hey, this stock has exhibited relative strength. The likelihood of this, the pressure lifting off as the market goes up, it will give you that confidence to see those examples, document them for yourself, build yourself some model books and some live examples. Could be 10 per cycle, 15 per cycle. Anything more than 0 will always add to your confidence at the end of the day. So let's get back to the 3 pillars. So we discussed mindset in depth. It's been 2 hours. We discussed 2 edges just to demonstrate the fact that you take a characteristic and you specialize in that characteristic. The first one we said was the highest volume. The second one we said was relative strength. Those are 2 very definitive visual characteristics. We talked about ruthless mastery. The first point was it has to be visualized. We visualized those and we went over examples. And now let's talk about the word setups, which a lot of people tend to, it's a pretty good marketing term. So we'll call them entry tags. So the first setup, Richard, if you want to go ahead and cover the Launchpad setup.
Yeah, sure. So the Launchpad setup, Ross is huge on this one. And again, it comes from studying a lot of charts. We're looking at the key moving averages, the 21-day simple, the 50 simple, 65 EMA, and basically watching for after a correction, we start to see a move upward, all the moving averages compress here, and everything moves together, and it's basically compressing the energy And from this bunch up of moving averages, where they're all very close within a few percentages, we often see directional movement in the stock and group to the upside. It's very similar to looking for the first base after the bottom, the stage 2 breakout. All these things are kind of looking for the same price and volume characteristics. So if you go to the next page there, we've got some examples. There's the Launchpad. You can see all the moving averages compressing together. I'll add my annotation tool so I can point some stuff out. Right here, you can see all the moving averages compressing together. We see some constructive price and volume characteristic where the stock is flagging out on a decline in volume. We see a breakout on increased volume, and then the resulting move upward.
And what made this a setup was, one, relative strength. That was the edge, right? Second, the moving averages were bunching up, so we now expect contraction in price, yield expansion, or volatility eventually, be it upside or downside. And the market came out of the 2019 correction, and Coupa Software went from 60 to 140 bucks. Me and Ross were both on top of this name, and we both had a position. So
yep. Yeah, I was just gonna say, but remember, just because this is a setup, this could have broken the moving averages and failed. So it's all about probabilities, knowing what to expect. This acted well, broke out on volume, but if this breaks expectations, you got to wait until it sets up again, and it could just need more time in stage 1. Moving over here to the right side, again, we see all the moving averages bunch up together within a few percent. We see constructive price and volume characteristics, and we get a resulting uptrend above the moving averages. So once they compress together, look for that expansion coming from that pattern. So that's pretty much it for the launching pattern. Yeah, go ahead.
This is also Coupa Software. So it's the same stock back in 2019, and I believe this is 2021. It did the same thing. Same exact formation, same Launchpad, right? Higher. This one had a little bit of a higher low. This one had, an equal amount of low, but they both exhibited this relative strength plus Launchpad on the right side that yielded returns. Coupa, this was the last bit of the Coupa run, and now it's pretty much
yeah. And if you study pretty much any leader coming from a significant correction, you'll see this Launchpad setup. It occurs again and again, and within groups as well. You'll see it in the ETFs. You'll see it as a whole in groups. What were you gonna add?
Yeah, someone was asking the stock name. This is Coupa Software, COUP.
Yep. So, all right. Moving on here. The gapper setup. This is your bread and butter. We've already kind of touched on this today, but do you want to?
We identified an edge. The gapper setup is basically, I tend to only look at where the daily closing range and the weekly closing range seem to be better than the markets, or greater than 50%. Those ones have the higher probability. Some, like Piton, when it did the highest volume ever back before its run, did not have a closing range of greater than 50% on that particular day. Could be a reason I missed that whole run. That's absolutely fine, but there's some metrics you want to define in terms of the quality of these names. If a biotech name that reports that fish oil is the greatest thing and they've cured liver cancer or something like that, and it moves from 2 to 14 in a day, it's hard to define risk on those names. Don't throw out everything else that and treat this as a golden egg or something, like whatever you think this is, but have, try to say, this is quality, this is going to move well, this is going to be tight, I can manage my risk, this has a good story, etc. Right? What the market theme or the market trend is. And then there's these other ones like GME, AMC type that can move up, right? DWAC, DWAC. Those ones are short term, they're much faster, harder to manage risk. They're not moving definitively. They're driven by events in the market where it's harder to manage risk. So there's that type of, setup, and then there's this other type of setup that happens. So learn to have identify quality, basically is what I'm trying to say. Learn to identify, the quality names from the other names as much as possible. So that's what this slide is about, so powerful gap up associated with catalysts, often linked with earnings. Look for overvaluing volume, that's our HV edge. Look for high DCR and a gap up to continue that price action. Often move starts with the gap up. We've seen that in many, many names. Even the smaller ones like CDLX, that's tripled. AEHR that went from 5 to 30. Arlo that went from 5 to 10, etc. Those all started from these powerful gap ups. Early gaps in a move are preferred. First gap up of AEHR was at 5 and it went to 30. First gap up of Arlo was at 5 and went to that. So there's, I know traders that say I will never trade a $10 stock. I know traders that only trade $10 stocks, etc. That you have to define for yourself. But if you see overwhelming evidence and a similar price pattern over a span of time and you master that, there's no reason you can't be trading those. So that's the gapper setup. And here are some examples. So we have, let me try to guess some of these. This is Twilio, I bet. Highest volume in a year and high closing range. That one continued up and out. This was kind of, I believe this was the very top in Twilio. Now it's at $50. But this was a run, 50% closing range, 67% move. The market comes out of COVID correction. This thing goes, right? This could be Snapchat. This would have been the third or the second gap up in Snapchat, greater than 50, 53% run. And this was also the top, likely, before we rolled over on many of these names. This one, highest volume in over a year, follow through, 50% closing range, markets in an uptrend, things are lining up, right? In terms of the setup, that's why I look for 50% closing ranges, increases my probability of being in a winner. So these are some of the examples that we have. Richard, let's cover the next one, the up the right side setup.
Yeah, so this is basically looking for shorter term entries in an overall strong stock, and this could be up the right side of a base or after it's already broken out the first few tight areas, pullbacks to moving averages, that type of thing. So here's some things to look for. Look for compression against support / moving average. Look for volume and price contraction as it pulls back. Look for a pickup in volume from that tight area. And this is just a nice reminder here. Leading stocks will provide multiple entries where you can manage risk even if you miss the base breakout. So even if a stock breaks out on the highest volume ever and goes up 20%, that's likely the start of a move. And there'll be multiple spots where the stock will consolidate, compress, tighten against prior support, a spot where you can manage risk, a moving average, whatever it is, anchor VWAP, and allow you to manage risk effectively and position in that name. I might trade, the HVC breakout. I might get in a little later. The point is identifying high potential stocks using the edges and then using your own preferred setups and entry tactics to execute, manage risk, and position in the name. That's kind of the key thing there. So moving on, we've got, I think, just one example. It's a little bit blurry, but there's just kind of multiple spots. Here's another Launchpad. This is kind of the initial spot to get in. Then we see some pullbacks to moving averages, some reconfirmations to the upside. Again, we form another base. We get the first pullback to the 50-day, and then some other tight areas. So you're just kind of looking for those individual spots. I believe, this is Neo back in 2020. Yeah, it says it right there. And I bought this right here, but I missed this entire prior move where somebody who likes the stage 2 breakouts more might have bought it. And this was one of my best performers along with Tesla that year. So there's many in a leading stock that's going to go up 200, 300, 400%. There's going to be so many different entry tactics, setups that you can use where you can manage risk. I personally like the tight areas and compressions versus that usually 21 exponential moving average. So Brian, I know this isn't your preferred setup, but anything to add on this one?
No, I think, Launchpad, relative strength, big volume causes that up the right side movement, right? So all those elements are kind of present over here. This is stretched into the move up the right side. So as long as you see contraction, when you see contraction, you can manage your risk. You can then place a trade. At the end of the day, all traders, successful traders, are trying to do is minimize risk, and tight areas allow them to minimize risk because they anticipate direction one way or the other and place stops relatively close to the bottom of whatever that tightness may be. So,
Yep. And we've got a bonus pullback to set a support or a moving average. This is very similar to the previous one. Look for prior strength, strong trend, and then pullbacks to key levels such moving averages. Ideally, you get constructive price and volume action during pullbacks. We always talk about the drift slowly back into the level versus, you know, a sharp decline. That's preferred. That's suggesting that institutions are still accumulating even as the stock is pulling back. And then we're looking for strength versus the key levels. We want to see evidence that it's being supported at that level, that the market is with us. Strength after the dip, Shannon always says, look for tight ranges at those levels. And examples of support could be tops of bases, high HVCs, moving averages, anchored VWAPs. Your style could just be, you know, after the breakout, look for that first pullback to the 50-day where it's been supported and look to buy that. That could be your bread and butter, the only setup you use in the markets, and you can make millions. So that's pretty much the bonus setup. And I think moving on, we've just got a few more slides. Here's an example. This is Uber. Again, here's the base. We get extreme power. You can see it was supported in this area. You could buy it off the 21 EMA here as well, where again, we form a tight range right here. So you could either buy the pullback or buy strength after the pullback. We've got the pullback to the 50-day moving average and as well to the 21 EMA and 50-day right there. So just a good example of a different areas, a pullback to, you know, this prior base pivot, that area, or the moving averages during the trend.
perfect. And we will get into the depths of, you know, how do you position yourself into some of these, you know, very specifics of this in webinar 3, 4, 5, and how do you manage, how do you create a portfolio that's could be a winning one over a span of multiple market cycles. So we'll get into the depths of each of these components. I know the last couple of slides may have felt a little bit fast, and all of a sudden we're talking about VWAPs and up the right side and all of that stuff. So we will get into the depths of that: portfolio management, risk management, how to sell, how to buy, etc. In subsequent webinars. So the back half of this is a little bit of a steeper learning curve, but let's get back to the basics of what we're trying to accomplish today. So simplification and specialization. If you focus, you know, I have a couple of books that I would highly recommend. This one's one, Atomic Habits. Another one that is completely different from Atomic Habits is the Hour of It. We know if you guys see this, but this one, these are more mindset type of things and how you can build habits over a span of time. I think a lot of trading, after you learn the basics of what you're looking for in the markets in terms of characteristics, comes up a lot from your routines and habits and how you think and what you're doing. How do you allocate your time? How do you prep for the markets when the market's closed so that your neurons are ready to make decisions when the market is open? So a lot of this comes down to that. After, you know, you figure out the very basics, peel back layers of confusion. If you are looking at, you want to be a Minervini, then you want to be a Brian Shannon, then you want to be this, and this, you want to be Stan. You're confusing a lot of what you want to be, you know, what could potentially be a lot simpler, so that when you are making a decision, it's based on what you have incorporated from different systems. Minervini is successful because he's taken bits and pieces of each system he's picked up along the way and made it his own system, right? He's not completely trying to be one person or the other. That goes for anybody. Stan Weinstein was the same thing. Nicholas Darvis was the same thing. Wyckoff was the same thing. They all took bits and pieces, simplified it to what they felt worked for them, and repeatedly did the same thing over a span of time. So specialization and simplification will allow you to go from stage 1 to 2, and from 2 to 3. Specialization is what, you know, all through stage 3. Minervini is not looking at dividend yield to make decisions. He's made a decision not to do that. I've made a decision that I know that, you know, relative strength high volume edge. These two things seem to be working for me. If I could just master these and just sit there and just look for these and specialize in them, I will be well off than trying to be someone, let's say, that becomes a Peter Lynch all of a sudden, right? So closing thoughts, last slide, maybe not. Every indicator and data point works. Comes back to our mindset. Every indicator and data point works. When someone says, Bollinger Bands don't work, they work. When someone says RSI doesn't work, it works. When someone says Fibonacci's don't work, they work. Your mindset should not be, hey, this doesn't work, that's why I'm doing this. It's more so people have specialized themselves into certain aspects that they repeatedly exploit from the markets, and they have moments where those indicators work and there are moments where they don't work. Don't have this mindset of what I am doing is the best and everything else is absolute bull. You know what? And that is not a positive thing to have if you want to, carry yourself in the trading world. Nothing is new in the market, but every moment is unique, right? So that's a little bit of tug and pull there. Characteristics that repeated themselves back in time repeat themselves at the moment, but this moment is very unique. You have to draw from the past, but treat it as you go forward day to day. And that comes from managing your risk, making your decisions in the moment. You can't say, I saw CE, I saw this stock back in 2004 had HV and doubled. You buy HV and go to sleep and say in 6 to 8 weeks, I want a positive result. That's not how it works. Failure is good. Stage 1 failure is good. Stage 2 failure is good. Failure is a positive. Use it as a weapon to improve. Go dig into those drawdowns that you're having and magnify them and look at why they're happening. Break it down trade by trade. Plot it on the S&P. Plot it on the Qs and see, I placed a trade here. Market was doing this. I placed a trade here. Market was doing that. Or the group was doing this when I placed that trade. Magnifying your failure and turning it into a weapon will always get you from stage 1 to 2 and 2 to 3 a lot faster. We need to place ourselves in a position to have the highest probability of winning. We will talk about this a little bit more. In this webinar, we identified 2 edges. We'll expand upon that. We will build continuously a framework to build a portfolio. We'll continuously add how we could stack our edges to have higher probabilities, and place yourselves in a position when a market is not trending and you're forcing, your opinion on it, it won't work. It won't work at all. So you'll have bad months, bad years, and bad weeks. Many of traders that I know had a flat negative month, year in 2022, for example. You will have those. It's all part of the journey. And there are some, things that if you have a certain type of system, there are times when it will not work for 6 to 8 months, and you have to sit there and you have to be confident. You have to have the confidence that this will come back, this environment, because that's just the nature of the market. Things will work in certain time periods. Things will not work in other time periods. Never giving up is key. Any trader that's been, here to tell the story did not give up when they were in stage 1 and stage 2. They kept going at it. They had the belief to say to themselves that I will make it, and it's a journey. That's why we're giving you the realistic approach, not the sign up and I'll teach you 2 setups and you'll be ready to go. That's not how things work, right? Joseph has been trading in the chat for the last 2 years, for example, the same HV setup. Now he's kind of mastered that over the span of 2+ years for him to be where he's at now, where it's just automatic, right? So it takes time. If you give up, you will never see the other side of the tunnel. If you just keep going, there's a chance, and there's a big chance if you put these, frameworks we talked about today, to go away from that stage 1 definitively to stage 2 and 2 to 3. Focus on do things yourself. You could go and grab bits and pieces of knowledge. You can go and grab bits and pieces of opinion. You can go and grab a tweet that David Ryan says the market stopped. The week after he was long. So if you follow him closely, the week after he was long. So try to do this internally. Try to have routines and habits and absorb and internalize. You can learn from others. You can learn from this webinar. But if you don't go back and internalize, what you're doing, it's not going to work. And that's just the nature of any profession, anything that you want to do in life, you have to absorb and internalize. So repetition and execution of an edge. We spoke about edge, so I wanted to close it there. You need a winning characteristic, be it Fibonacci, Bollinger Bands, RSI, MACD, HV, PEG, EP, I don't know, name it, stage 2, whatever. You need some sort of characteristic that you've identified, and you want to repeatedly exploit that in the markets. So download the Ultimate Trading Guide. The link is in the chat, Richard, if you want to throw that in. It's also in the description. I genuinely want you guys to share this everywhere on social media, friends, family, etc. Whoever can benefit from this series, the more people we get to watch this, the more motivated me and Richard are for the next webinar, right? To make this as kick-ass as possible. And we will keep going with this and continue to build upon the frameworks of this Ultimate Trading Guide. So recommended tool, obviously, you want to get in on the next true market leader. It's going to be deepvue.com. It's going to be this platform. We will incorporate all user feedback that we receive. That's just going to happen. The folks behind it, me, Richard, Nick, and Ross, we've spent many, many years with TraderLion, educating folks, etc. We're taking all of that and bringing it to this tool to make this the best possible platform. We have a lot going on, a lot to offer. Right now, the pricing is $50 a month. It allows us to grow at a steady pace, reinvest in the business, and continue to make this platform better. And definitely, if you want to hop in early for the ride, this will be the lowest possible monthly price that we will offer. And this will also be the lowest possible annual price at $490, which saves you 2 months that we will offer. We can't guarantee as we scale, because as we add more and more, infrastructure costs rise. And we're trying to fund this based on the folks that signed up early. So $49 a month, you get everything. We have stage analysis. We have any technical scan you could think of, any fundamental scan on EPS sales, future estimates. We have visualizations not available. The RMV we just rolled out, which is a concept around how you can scan and visualize tightness for a stock. So all of this is going on within Deepvue, and we're going to roll out the dashboard, iOS, Android mobile apps, a whole bunch of data, and likely go global early next year as well. So this is, you don't want to miss this. I'm telling you, you'll watch this maybe a couple of months down, likely the pricing will not be the same. This is the lowest possible we could offer in order to continue to grow the business as well. So download the Ultimate Trading Guide. Again, questions, Richard, maybe we could take a few for 5 minutes or 10 minutes if you want.
Yeah, sure thing. And I'm going to drop in the chat here a link. Again, we want this to be shared as widespread as possible. And what would help with that goal, if you've enjoyed this, if you find value in this, which a lot of you have stuck around until the very end, which is awesome, please help share this. This is the link that lets people know about the sign up link for the next webinar, which will be next weekend. So that link is in the chat here. Please go ahead, give that a click, tweet it out. We'd really appreciate it. And it helps let other people know about this resource. So we'll take maybe a few questions here. Yeah, thank you. And thank you to everybody who does that. That's awesome. You can help other traders around you just like you. There's some questions about for Deepvue, international markets, especially India. Ryan, if you want to address that.
Yeah, India, I mean, there's a chance we go global relatively quickly. I'm not going to put dates on it, but yes, we're aware that a lot of demand in the Indian market. So anything that we are implementing at the moment with respect to technical fundamental data points, when we add market support for other exchanges, Deepvue will scale, and we don't have to redo much of what we're doing for the US market. So when we add a journal, when we add apps, when we add a dashboard, etc., all of that will be scalable to all market types, including Forex, crypto, etc. So that's coming early next year. The more support we get, right? What we're doing is, our user base as it expands over the last month, it has expanded, tenfold. As we continue to grow, we're reinvesting all of that to develop even quicker, right? So it's the same thing with TL. We did the same thing. Deepvue is the same thing. We want to keep the cost low as much as possible, but have enough of a skin in the game so that we could catch up to these competitors, but lead in certain areas and make this the best possible platform as well. So
Yep, perfect. Let's see here. Um, After seeing contraction on the daily chart, do you go down to an intraday chart to trade? I personally, daily is kind of the main one. That's where my main levels on weekly and daily, but I will use the 65-minute time frame to look for pivots. But if it doesn't look good on a weekly and daily, there's no reason at all to be on an intraday chart for my trading style.
Yeah, so for me, it all depends. If I'm looking at, if we're talking about the HV setup, for example, I will go to a 15-minute, 5-minute, just to see how that HV day traded. Where was the bulk of the volume that came in to move that stock up? I'm most interested in that. And the next day, if it were to come in that range, I can then simple volume support, right? Price rises on increasing volume, right? And as price comes back in on decreasing volume, that volume will act as support because most market participants were driving the price up at that price point. We'll cover that in framework 3 next Saturday in depth. So that's one way I look at it. So it's not about, do you only use daily and you never look at 5-minute? I never say never. So if I'm trading on the weekly, I will look at the daily. If I'm trading on the daily, I will look at the, maybe 5-minute, 15-minute to prep when the market's offline. When the market's open, I will have a 5-minute up. Well, that doesn't mean I will be making my trading decisions based on that particular time frame. Most of my decisions are on daily or higher. So.
All right, perfect. I think we can leave it there. Thank you guys all so much for tuning in. Hopefully you found this helpful. Let us know any feedback for us in the chat. And we'd love to hear now, if you could put in the chat, what's been your favorite part of today? That way we know what to touch on more. And we look forward to seeing everybody, in the future webinars. We'll be doing this weekly and hopefully building a really great resource for traders in stage 1, stage 2, and going towards that stage 3. So thank you guys all for tuning in. Ryan, any words that you want to leave everybody with?
No, I just make some noise, on socials. We had, higher than the first webinar in terms of live participants in here. The more people we get, the better, this resource is going to get, the better questions we'll get, and the more questions that we answer, the more learning on your guys' part. So with that, I think we could cut it off, and we will see you guys next Saturday at 12 p.m. Eastern. This is recorded, by the way. So.
I hope so. No, it is. It is. Yeah, perfect, everybody. Thanks again for tuning in, and have a great rest of your Saturday and your weekend. Cheers. Bye.
Bye.